I mean, the reality is if you can't, if this, you can't get to January, have a bad January and say, yeah, well, it's valid. It's not the January effect isn't valid this time because, or, sell in May isn't valid this time because you just have to take the fact that the future is unknowable and it's the future, and you have to figure out how to live with that and wrap your head around controlling what you can control. Well, welcome to the Money Alchemist podcast. I'm your co-host, Brent Gargano.
And I'm Ben Jones.
And I'm happy to be back after a little
hiatus.
We'll call it that. I missed the podcast last week because of some car trouble. So
yeah, you had quite a few kerfuffles, if I recall. You also had an air conditioning issue.
Well, that brings us right back to the concept for today. Yeah, summer is in full force. I have a Nest thermostat, and I could look and see how hard my air conditioner is working. And I'll say that my old air conditioner, which has been at the house since I bought it, finally decided its time was gone. And what was neat is I could see on the data exactly where it broke, because it went from like having to run 30 minutes every other hour to just running 100% of the time.
Mm-hmm.
So we got the AC done, car fixed, and we're back recording.
Yeah, well, glad to have you. We had Jim Blair in last week, and he did a great job going over Social Security and all the ins and outs. I mean, that guy's been in the Social Security field for over 35 years. I mean, he's forgotten more about the topic than you and I both know. So it was great to have him. But today we got something different lined up, and that is market seasonality, So unfortunately, we do not have any sort of central heating and cooling to buffer our portfolios from this reality. And that is that there's a tendency for markets to underperform certain periods of the year.
Well, it's summertime, right?
Yep.
I mean, we've maybe if as a listener, if you're not familiar, there's a phrase in investing called sell in May and go away. And it's a phrase that's been around for literally hundreds of years, and basically references the idea that summertime, take your investments and, take a break and come back, once everything's.
What's the history of that? When did that start? When did that become a thing? The whole sell in May, go away.
Yeah. So I actually did look at this. It goes back to like the 1700s. In Europe, I guess in London, it used to be sell in May and go away, come back on St. Leger's Day. And if you look it up, I'm not a horse racing expert, but I guess there's a big horse race in at the end of September in London or in UK. And so this phrase, I mean, literally goes back to the 1700s.
What is St. Leger's Day?
It's a horse race. So I think it's a 4-day, if I remember it right, it's a 4-day long, take the horse racing that we know here in the US, and gosh, that would be a mess.
Horse racing?
Have you ever been to a horse race?
No, I can't say I have. I've never found the topic to be that interesting.
To me, it's a lot of like hurry up and wait. You sit there for an hour, and then they run the race, and takes a couple of minutes, and then it's kind of over for a little while, and everybody goes and collects their money or whatever they do. But
you mean licks their wounds, because most people I imagine are losing. All right, so I looked up what is St. Ledger's Day. So St. Ledger's Day, also known as St. Ledger's Day, AI for you. It's like, well, no, duh. St. Leger's Day. Okay, so they spelled it different. So one spelled Ledger, this one spelled Leger. So the idea was as early as how long ago was this? 1800s?
1700s.
1700s. Okay, so in the 1700s, sell your equities and rebuy them after the horse race with all your winnings.
Yeah, I think what's interesting there is, most people when they hear like a wealth manager talk about long-term stock returns, I mean, we have so much data that looks at like the last 50, 70, maybe 100 years, but like the reality is these concepts that we talk about and the idea of markets goes back way longer than you think. And so even in the 1700s, they had, exchanges in London, and the idea
Yeah.
was, take your money and come back in the fall.
Yeah. And actually, historically, it's funny that that saying started in the 1700s because historically, if you did follow that pattern, it did work. I mean, if you sold in May in 1929, you would have avoided the bulk of the financial crash, the stock market sell off in 1929. So let me look at that chart. When did that start? Um,
Yeah, I mean there
so
are some really notable
yeah,
things.
the peak of the S&P 500 was in August of 1929, and then the trowel happened in May of 1932. So when would you buy? When is St. Ledger's Day? When should you buy back in?
I think it's in late September.
Okay, so you would have, yeah, well, you wouldn't have. You still, if you sold in May and went away for the 1929 stock market crash, you would have just avoided. You still would have gotten your can wax there. So you would have definitely did pretty poorly. But historically, it is borne out by the data that September is on the average a pretty terrible month. So what do you make of that? Actually, let's talk about the numbers because I think Fidelity posted some of this data. So where
Yeah. I remember when I started investing, it was 2010.
Mhm.
Um, and the first few months of investing was great, but the summer of 2011, I remember my birthday is in September. And that was the first September that I learned that my birthday month is really just not a good month to invest. I feel like every summer, August, September timeframe, it's seemingly, I mean, this is anecdotal and doesn't actually bear out in the data, but it's seemingly it's just a brutal period of time for stocks.
it wasn't S&P, it was your Ycharts data here. So this only goes back since 1950, but these are the sell in May, go away average S&P 500 returns since 1950. Well, the worst month on average since 1950 in the S&P 500, which is the 500 largest stocks in the U.S. stock market, is September with an average return of negative 0.72. So on average, you lose money. Now, this is the average. We were talking before recording there's a big difference between the median and the average. My suspicion, and we couldn't find any data on the median return here, but my suspicion is that there are some doozy months that skew this negatively. So if you look at the .com sell-off, if you look at the great financial crisis, and if you look at, for example, the COVID crash, the full month of September was negative in all three of those. So it's just September's just an unlucky month where it just happens to be placed perfectly within a lot of these major sell-offs, not all of them, but a lot of the major sell-offs where the whole month is realized during that market decline. And this it also is borne out by the fact that August is also a negative month. So on the since 1950, so August is negative on average, negative
Yeah,
0.01.
it's basically flat.
Mhm.
But like, make no mistake, it seems like, I mean, we according to some Fidelity data that we have, the market on average from May through October is up 2%.
Mhm.
Okay, so it's positive over the period, but positive about 2% with some rough months in there. The other 6 months from November through April, positive 7%. So it's there is clearly a difference in terms of the 6 months versus the other 6 months for average market performance. And you may be right that that's pulled by, pooled or pulled directionally by, certain things that have happened. But, what do you say to a client that asks you about something like market seasonality, or, maybe they ask, market, for example, this year has done really well so far. So is it time to take some chips off the table?
Well, I think market seasonality, if it is actually a thing, I think you can back test it, and it looks like a legitimate strategy. You're like, wow, if I just avoided the month of September, I could just save myself a lot of portfolio heartache. Well, you also would miss a lot of big years or a big up years as well. So by avoiding all Septembers, you may have missed, and historically, you may have missed some of the bulk, like a big portion of some of the biggest sell-offs that we've had, like the dot-com sell-off, the housing sell-off, the financial crisis sell-off. Even I forgot about 2011. You remember the sovereign debt crisis? That was also perfectly aligned with
Summertime.
September. So yeah, you would have missed a lot of these, but you would missed a lot of up months too. So, and who's to say that this isn't just random? I mean, explain to me how the month of September, what that has anything to do with, dot com companies and their profitability and whether they go, bust or not. What did that have to do with the financial crisis? I mean, the answer is nothing. I think it's just random. It just happens to be one of those things that the universe just organizes for us out of chaos. So when you make an investment decision, Warren Buffett had a really good video I watched this morning on that about intrinsic value. Never mind the term intrinsic value. I kind of disagree with. I think all value is subjective, but what he was describing as or defining as intrinsic value is essentially like, when you invest money, you're literally just buying the future cash flows of an enterprise. That's it. I mean, when you boil it all down, like whether you're making, AI chips, whether you're making, delivering goods to people's doors, or you're serving food at at a restaurant table, ultimately you're in business to make money, and when you invest in that business, you're just simply buying the future cash flows of that business at a discount rate. And that's all Warren Buffett was saying. I mean, that's fundamental analysis at its core. And when you're talking about, well, should I invest in this company because it's August? How does that? What does that got to do with the price of bread? That has nothing to do with the fundamentals of the company. That is a purely like superstitious, kind of. I'm trying to avoid bad juju kind of
Well,
decision. And I don't think it's based on sound logic. It's based on historical patterns. And I think we can fool ourselves into believing historical patterns are, that they are patterns. In fact, it's just random.
but to me, what stands out when you look at the average returns every month is there's only 3 months that are on average negative.
Mhm.
February, which, by the way, February comes after a monster November, December, and January. Basically, the average returns in November almost 1.8%, December 1.5%, January another 1%. We basically, on average, have like a 5% rally from November to January. February cools off. August is the next month that's negative at basically flat, and then you have a bad September. So the way that I read that is there's a lot more good than bad, and I agree with your point that you can't control the timing of some of these things. It might just have happened that the market, housing crisis happened in September or whatever. But the point is, it's not a good strategy to be uninvested in general because there's more ups than downs. We have some data here that shows this. The chart actually shows what if you had been invested for the period November through April and then sold all of your investments from May through October. how would that actually pan out for a portfolio? This looks back a long time. I mean, this data goes all the way back to 1950, but it would play out regardless of the period that we're really looking at. Essentially, what it shows is that by leaving your money invested, you earn basically 3x the return of having sold in May and stayed in cash through November. So, and I want to highlight the difference here, okay? Because when I was a kid, I used to watch the Barrett-Jackson auto auctions. You remember, I don't know if you've ever seen these, but you'd have these classic cars that people had bought decades ago that were, they'd put like on the screen, they'd say, hey, this guy bought this car for $3,000 in 1935, and now he's getting ready to sell it for $100,000. And I remember being like, wow, how cool would it be to be able to make that kind of money? So let me put this into perspective. Since 1950, and I know it's a long time period, but the S&P 500 total return left alone is 31,580%, roughly. Okay. So to put that in terms, that's 310x your money, if I'm not mistaken.
Mm-hmm.
So what does that mean? If you had $10,000 in 1980, or in 1950, you now have what, 3.2 million almost? 31,580% return. Divide that by 100.
Okay, so 3.5, so that's 318.8
times 10,000.
That's 3.1 million.
Yeah.
3.158 million.
So had you invested $10,000 in the S&P 500 in 1950, today, that would be worth over $3 million. Think about that. That's a massive return. And by the way, had you invested it, I probably should have started with this one. Had you not been invested for May, your return gets cut down to 12,000%.
Well, here's
you only have 1.2 million.
Here's the funny thing, like sell in May, go away is not aligned with the reality of the present. And that is really what you should be doing is sell in August and come back in January. That's, or maybe December.
Come back in October.
Yeah. So that's where the present opportunity is. If you believe in seasonality, I don't necessarily, I'm not buying into seasonality. I think that's the historical, just coincidence. It's just coincidence that the weakest month happens to be September. But there's got to be one month that's weak. That's just the way the data is. Sometimes the data just doesn't mean anything. And I think we're trying to like search for meaning in all this. Like, okay, well, what should I do about that? It's like, well, nothing. You should do nothing. That's what you should do with it, because there's no guarantee that next September we're going to have a massive sell-off. Well, with this coming September.
Well, and I would also argue when you look at investing and how to become a successful investor over time, it's not always about not being invested for the downs. Like when we build financial plans for clients, we build those plans assuming that you're going to hang on through market downturns, that you're going to lose money at times when the market goes down. What we're not assuming is that you stay in cash for a long period of time, or any period of time really, and miss percent. If you uninvest and the market goes up 5% and you buy back in, you're never getting that 5% back. It's gone. That is a permanent loss in your financial plan. Whereas the market dips 5% and you're invested in that and you stay invested through that and the market comes back, your financial plan is already built around the assumption that that's just part of what's happening. So to me, there's a lot more risk in being out of the market while it goes up as opposed to being in the market while it goes down. Now, that doesn't mean you can't think about how to protect yourself from down markets, which is why we talk to clients about the importance of having savings, about thinking about your shorter term goals, and making sure that the money that's invested in the stock market isn't something that if September or if August and September have a bad month, you're taking money out of the market because you had to, and you're not set up properly for that.
What do you think it is about? What does it say about us that where we feel it necessary to try to come up with this kind of stuff, like sell and may go away, and and really the thought of sell and may go away is what we're trying to do is how do we avoid the worst months out of the year, and I think it all ties into we all have we're all biased towards regret aversion. We want to avoid regretting a decision, and choosing to stay invested is a decision. And we feel like if we if we fail to make the decision to exit out of a peak and we review our portfolio a couple months later and it's down 10, 15, 20%, that we just feel intense regret and self-loathing. you know, I think that's what's fueling this superstition. And it's what it is. Sell and may and go away is a superstition.
I think that fear drives a lot of behavior, right? And nobody likes losing money. I mean, we talk a lot about portfolio volatility and the importance of staying invested and holding on through down markets. And we look at these charts that show these, little peaks and valleys that have happened over time. But when you live a 6 to 9 month period of time where the market's messy or longer, I don't think the chart really does the period of time justice for how that feels. So, I think people in general want to protect themselves from losses. I think that's human nature.
I think it's more than just protect against losses. I really do. Because how do you explain? I think it's the same behavioral mechanism that goes into this whole, what's this guy's name? Not Hello Kitty. I want to say Hello Kitty.
Roaring Kitty.
Roaring Kitty. This roaring kitty phenomenon that's happening right now. The guy is a nut. He's an absolute nut. For those of you who don't know, he's the guy behind this whole GameStop meme, where apparently he invested 50,000 and some sort of short squeeze. He got his Reddit community to corral around him. Anyway, I don't want to explain the whole thing, but somehow 50,000 turned into 150 million.
He's got a lot of money these days.
But it's just, things like that happen in life, and we tend to look at him with some sort of awe, like, oh my gosh, this guy must be some sort of genius. No, I think he was just the right place at the right time. He captured lightning in a bottle, and someone's got to do it. But now he's got this whole community behind him that are trying to do desperately. They're desperately trying to capture the same lightning in the same bottle. And that is the same thing. It's FOMO. They call it FOMO, fear of missing out. And that is the same behavioral thing around not avoiding what you call avoiding losses. I think I think what it is, it's regret aversion. And regret can happen if you don't buy into something that shot to the moon, like GameStop, or what's the big one now is NVIDIA. Everybody's like, should I buy NVIDIA? It's like, well, maybe 5 years ago you should have.
Well,
not to opine on that. I mean, honestly, I don't know if you should buy NVIDIA or not. I mean, I'm a long-term buy and hold kind of investor. Time will tell. If I certainly don't think you should concentrate any of your money in any one individual stock. You should stay diversified, but that's besides the point. I think that back on the rails here, what's driving this, sell and may go away mentality is the same thing that's driving these people to pile into, momentum assets, whether that's a hot stock, a meme stock, it could be a cryptocurrency, doesn't matter. I think everybody just is afraid. They're just afraid to make the wrong decision and regret it later, whether that's a buy decision or a sell decision. And I do think, though, that the pressure is more pronounced on the sell side. So, because I think we feel losses way more than we feel gains. I think it was like 20. The studies show like 20 times we feel losses
I think
more.
the losses are 2x
Oh,
as
2x.
hard
Okay. Yeah,
as the
but that's
gains.
so subjective. Like I think it
Yeah.
depends on the personality. There's some people I know that, they feel losses 100 times more than they feel gains, and I know people that, they really are fine to they're okay with losses. But what they're not okay with is missing out on a huge opportunity.
While
Yeah.
I agree with you that I think we make a lot of these seasonal patterns up, as somebody who like I notice my birthday is in September,
Hmm.
and I joke about how my birthday month is always always seemingly a tough month on the markets, and so whether it's September is just a slow time of the year, or whether it's something more like, hey, December, you have holidays, and January and February, you get employee bonuses. And, I mean, there's other things behind the
Well,
scenes that can drive.
the January effect is actually, proven to be a reality, and that has to do with U.S. tax law, where there's a lot of losses that are realized, and gains too, that are realized by the end of the tax calendar year, December 31st. And so, there's a lot of short positions, not short positions, but there's a lot of um, selling that happens with long-term money that gets redeployed in
But
January.
isn't that just a net wash?
It should be, but the thing is people realize that this is happening. So I think what you get is a bandwagon effect where, because investors know that this is happening, that they also put their cash to work in January, thinking that they're going to get discounts on equities, and what you end up getting is herd mentality.
Well,
Um,
I'll say, going back to the average monthly data, I mean, November, December, January are a very strong 3 months. Your point on the January effect. So we do have a statistic here on the January effect. I mean, the January effect is not, we haven't talked about it yet, but it's another seasonal um, market belief, and that is that basically if January is up, so goes the year. So there's data basically that shows, if we have a good January, that generally the rest of the year is good. But similarly to what we found with the sell in May and go away, had you managed your portfolio for the January effect, meaning if you had been invested, if January was positive, and if January was negative, decided to sell out, you still would have cost yourself, since 1988. And I know all these time frames are different start dates, but since 1988, a portfolio that started as $10,000, um, or started as $100,000 rather, would grow to 3.6 million roughly invested the whole time, as opposed to little under 2.5 if you sold if January was a bad month. So none of these strategies really play out with any level of practice. And if they don't play, or with any level of predictability, and if they don't, then are they useful at all? I mean, the reality is, if you can't, if this, you can't get to January, have a bad January and say, yeah, well, it's valid. It's not, the January effect isn't valid this time because, or, sell in May isn't valid this time because. You just have to take the fact that the future is unknowable, and it's the future, and you have to figure out how to live with that and wrap your head around controlling what you can control.
yeah, let's do a thought experiment real quick. The reason why market seasonality bets don't work is because ultimately you don't know. You're trying to predict the unknowable, which is the future. The fact is that the market is just a collection of independent minds and actors. And for you to try to predict every single psychological state that goes into whether or not that individual actor is invested or not is impossible. It is not, and for you to try to make these predictions short term, and I would say anything less than 12 months is definitely short term. And that's really what we're talking about here. We're trying to figure out, like, okay, well, should I be out in this month and be in on that month? I mean, that's like, first of all, it's a recipe for migraine inducement. Second of all, like, it's just not, Like, yeah, historically, you could have avoided some of the biggest sell-offs if you just, at the past 20 years at least, because this is one thing we haven't talked about is like that used to be sell and may go away, but in the past decade, the worst month has shifted to September. So if you look at this report from Invesco here that we have in the show notes for those of you not that want to follow along on this, it's the chart says since 2000, January's tendency to be the best performing month has faded, but also at the same time, if you look at uh, the market, that's also when September starts to show up as the worst month. So, which is very, very interesting. So the seasonality shifts is all I'm trying to say. So because historically the worst or best average month, analysis is of the averages is average analysis. You heard that before. But just because this month is on average the best and this month is on average the worst, tells you absolutely nothing about the next 12 months.
Right.
Like you may think it does, but that's an emotional bias. That's animal spirits, as they say, or just tea leaf reading, and you're fooling yourself if you think that a non-fundamental data point like that which is correlated, yes, causal, no, has anything to do with whether or not your investment decision is sound. As Warren Buffett says, the only reason you're investing is to make money. And the best way to make money is to invest in companies that have, or just investments, not necessarily companies, but we like companies the best. He calls those productive assets, right? It's to buy good, high quality future cash flows at the deepest discount possible. And that's it. And you just hold it. And if the market, says, oh, okay, this September is a bad month and everybody panics and then herd mentality sets in and then your portfolio is down 20, 30%. Meanwhile, your, fundamental analysis suggests that, hey, this portfolio is actually worth more than what I bought it for. Well, maybe you should buy more at that point because now the market's given you a gift, and that is a high quality asset that's on sale. That's the way I look at markets. I completely disregard market seasonality. It's interesting, but I don't necessarily think it's worthwhile in terms of belonging in your investment policy statement. So, what are your thoughts?
I agree with you that the future's unknowable, so there's just no way to build a plan around what might or might not happen in this season. I'm still looking at these average monthly returns, just thinking, one of the months that I always hear is supposed to be a bad month because everybody owes taxes is April. April has an average almost 1.5% positive.
Well, because most people get refunds, that actually tracks. I think there is some truth to the seasonality of the January effect. And then also, that didn't surprise me that April's a good month because people get tax returns.
What percentage of the stock market, though, is the retail investor that gets a tax return?
Yeah, that's another thing. It's probably pretty small.
Yeah. I mean, I don't know.
Although it's a growing number.
I guess my point is like some of these things, I mean, the Santa Claus rally, that's another one that we talk about in our industry. That's, it seems, pretty logical. October, November, December, pretty strong months. January effect, there's data that says that, hey, if you have a good January, the year ends up positive. Now, most years on average end up positive anyway. So again, is some of that in place? But if I'm trying to manage my own personal finances and I'm listening to this conversation, the way that I think I need to internalize this is that what we preach to our clients, which is make sure that you have the right amount of savings on hand. Make sure you're saving for your short and medium term goals. Make sure that you're allocating long-term money towards long-term assets like stocks, real estate, things that hedge your inflation risk over time. And make sure that you position yourself both situationally through that savings and everything else I just mentioned, but also emotionally to stay invested through the downturns. Because what matters is not that you, again, back to what I said earlier, is not that you avoid a temporary downturn. It's that you don't take that temporary downturn and make it a permanent loss in your portfolio by realizing that loss in that moment. And that's easy to say. It's kind of one of those things that's simple, but not easy in practice.
Well, I mean, that's why you get economists like Richard Thaler. He said he was asked a question during the COVID panic that, what's the best investment for retail investors to look at right now? And he said, it's unknowable. The best course of action is for investors to pick a sensible asset allocation and then ignore it. You want to be benignly negligent. And I thought, man, what better way to put that? You just can't predict these short-term swings. You can follow Hello Kitty or whatever his name, Roaring Kitty, if you want, and try to make a banger return, a 10-bagger, as they say, on GameStop futures and shorts and all that crap. I just think it's all noise. It's just, it's static, and you're going to end up screwing yourself up more than you are helping yourself. You just want to consistently save, show up to work, earn. That's the most important thing, is you have to earn an income, and hopefully you can earn an income that's above what you're actually worth in the market, and then save that income. I generally tell people save like 15 to 20% of it. If you're spending all of your income, then one of two things needs to happen. You either need to find a new job where you can save 10 to 15% more,
or increase your income.
Yeah, or increase. Yeah, well, that's what I meant. Find a new job. It increases your income, or you need to cut your expenses. I think everybody defaults to cutting expenses. I think that's the wrong way to look at it.
You can only cut expenses so far.
I know.
You can increase
income. Especially when inflation, the 4-year average rate of inflation is like 23%. Prices of goods are up 23% from
over the last 4 years.
Over the last 4 years, like how much you gonna cut those expenses? You need to find a way to earn. But that's besides the point. Like these are the things that matter in your financial life. These are the things that propel your net worth, not seasonality.
Not did you sell in May?
Yeah, not what can I do to capture Roaring Kitty's lightning in the bottle? What can I, not piling all your money in a cryptocurrency because, that's what, so-and-so did. And now they're up 10,000%. They got a beach house. It's like, okay, well, maybe one day you'll be lucky and you can put a little bit of money in an investment that goes up, 23,000% in 5 years, but it's just rare. You might as well try to become a YouTube star. These things do happen to people. They do. And I'm not saying that you should just ignore it altogether, never buy a lottery ticket. I mean, it can be fun, but just don't base your financial plan on it. That's not even plan C. That's like plan Z. That is so far down the alphabet that you're not even, it's just like a wish, Yeah.
The phrase is control what you can control.
By the way, I did look up what percentage of retail investors comprise the stock market. It's 25%. And it is growing. So it's double the amount reported from the prior decade. So that does not surprise me at all, given that, we're all just piling money into our 401ks mindlessly, which is actually a good thing. So as Richard Thaler said, pick a sensible allocation, stick with it, be benignly negligent. Don't try to time markets, even though there's some truth to some of the seasonality stuff like the January effect and possibly April. I just don't think there's enough alpha there for it to be worthwhile to try to time it. And it's just ultimately going to be headache inducing. I don't see the value in it. I don't do it.
Yeah, no, I agree wholeheartly. Well, I think that's a good spot to wrap up. And we've talked through a good amount of this seasonality stuff. Thanks so much, Ben, for having this conversation.
Yeah. Thank you, Brent. Where can people find you?
Yeah, you can find me at www.infinitewealthplanning.com or check out Brent Gargano on LinkedIn. What about you, Ben?
Yeah, best way to connect with me is through X. My handle is at the Carrot Stick. That's KARAT stick. All this is in the show notes too. So if you're listening and you want to follow along with us, all our information will be in show notes. You can connect with us and learn more about what we do and how we can help you. Securities offered through LPL Financial, member FINRA, SIPC. Advisory services offered through National Wealth Management Group, LLC, a registered investment advisor and separate entity from LPL Financial, LLC. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. This information is not intended as authoritative guidance or tax or legal advice. You should consult with your attorney or tax advisor for guidance on your specific situation. Brent Gargano is not affiliated with LPL Financial.